Hi, I'm John Papola, and you're listening to the Emergent Order Podcast. In this episode of the podcast, I share a great conversation with John Allison, the former CEO of BB&T and former CEO of the CATO Institute. John has an incredible career in banking. He grew BB&T from a small regional bank to the 10th largest bank in the United States, and was in that firm through the financial crisis of 2008. And so we spend part of our conversation really diving into that experience. And then we also spend some real time digging into the values and the philosophy that have guided John. So I hope you enjoy this conversation with John Allison. So, John Allison, you are maybe the most philosophical banker in the world. How did this come to be? Where does your story? Let's start with where your story starts on the road to becoming a banker, and then we'll connect to the philosopher.
Well, John, it's interesting. Nobody in my family had ever been a banker or a lawyer or a doctor. In fact, I was the first person in my direct family to ever graduate from college. I got interested in finance by taking a college course, and I took a job at BB&T, which at that time was a really small farm bank. And honestly, I didn't expect to work there very long. I wanted to go back to law school. But when I got into banking, found out that it was something I could be very interested in, and I got to work a little bit with attorneys, and I found out I really didn't want to be an attorney.
Why? What was it about? What was it about banking that attracted you?
It was interesting because you got to work with a lot of different businesses, and you got to, in my case, particularly early on in my career, you got to work with a lot of small companies where you could add value, where you could provide them the kind of financial advice, because maybe they understood the mechanics of their business. They were good production people, but they really didn't know much about finance and managing their overall financial affairs. And the whole idea of adding value appealed to me.
You know, I don't think most people really understand what banks do. So could you explain for me, like I'm a child, what a bank and what a banker does?
Yeah, John, and I think it's important to distinguish between what I'm going to call commercial banks and investment banks, because investment banks really do something very different than commercial banks. Commercial banks, which is traditional banking, basically take deposits from individuals, their savings, and put them in certificates of deposit and pay their interest on those savings. That allows individuals to get a very secure investment that's very liquid, and so they don't have to be sophisticated to make that investment, because the bank industries are sound. They take that money and they loan that to both businesses and consumers. In our case, we did a lot of small business lending and middle-sized company lending and a lot of consumer lending. We financed a lot of houses, automobiles, when people wanted to buy boats, second homes, those kind of things. And so banks are actually lending your savings to other people who don't have the money now. And a lot of part of it's demographics, in the sense that older people tend to have more money saved. Younger people tend to have more needs, like to buy a house. Startup businesses tend to need more money. When a business gets successful, it actually has a lot of cash. By doing that, banks make people's savings far more productive than they would otherwise have been. And because commercial banking is traditionally largely a community business, commercial banks have local knowledge of the market. So they know individuals, they know what the business climate is, and they can make smaller loans than the so-called capital markets could do. In my career, I helped start many small businesses that have grown, and a number of those businesses have thousands of employees. And that's what can make it a very rewarding business. Now, there's a Wall Street investment banking side, which is not the same thing as commercial banking, even though they're called banks.
And just like briefly, what is that all about? Because I think that distinction, that at least for a time during the financial crisis, this question of commercial banks and investment banks and the way they can or can't or should or shouldn't be housed inside the same companies became a thing. So what do investment banks do?
What investment banks largely do is do bigger projects that are more complex, that requires a lot of capital. Traditionally, investment banks don't raise money from the average consumer. They don't get deposits like you have in your checking account. They get their money from other investors, maybe a pension plan or some kind of mutual fund that has a large chunk of the money. And investment banks can either provide bond financing for a big company, or they can help companies raise equity. They can help them sell stock in the capital markets, which they need to grow their business. So there's nothing wrong with investment banking. It's just generally far more sophisticated, far more complex, and on a different scale in terms of the size of businesses that investment banks traditionally usually deal with. I don't think there's any evidence, however, that the fact that some commercial banks had got into the investment banking business had anything to do with the financial crisis. I think there's no evidence that would support that.
So to come back to the start of your career at BB&T, what was the first thing that you did? What was your first job? And how did you get it? How did you get your first job at BB&T?
Well, I was hired out of college, directly out of college. I interviewed with the bank. Theoretically, I was hired for management, but the bank really didn't have a management development program. So I did all the basic jobs. I was a teller, and I wasn't just being trained, for a teller for a few weeks. I was a teller for a while. I worked in the bookkeeping department for a while. I did a lot of the basic mundane jobs, operational jobs that go on in the bank, which actually turned out to be very helpful in my career. So even when I got to be CEO, I had a pretty good feeling what the teller's job looked like, what the customer service representative's job looked like, what the people in the back room had to do to make their work successful. But I did basic work. Relatively early on, though, after I guess about a year and a half, I got into the lending business. I went through a time when I was kind of an apprentice, for lack of a better word, learning about lending, and then I started making loans and supervising other people making loans.
So I think for the average person that's gotten a loan, whether it's on their car or on their house, which is I think probably the biggest loan most Americans will ever take out. You come into the bank, they ask you to fill out a bunch of paperwork, they ask you about your income and whatnot, and then it goes off to these other people called the underwriters, and they make some decision. So pull back the curtain on that. Like when you, in learning how to make loans and how to make those decisions, like how are you doing that? How are you doing that on the personal level? And then how are you, I imagine for small businesses, it's probably even more difficult because somebody comes in and they say, well, I'm expanding my hog farm and here's my numbers. And, if you're not a hog farmer, how are you supposed to know whether their plan makes any sense and what interest rate you should charge them? And, try to break it down for me.
Well, the kind of basic questions you're asking is, what is the purpose of the loan? In case of somebody buying a house, that's very clear. Somebody that's running a hog farm, are they increasing their inventory of hogs? Are they adding new facilities? So what's the purpose of the loan? The second kind of thing you want to know is how much money the person needs.
Right.
Again, buying a house is pretty straightforward. If a hog producer is going to increase the number of hogs, it's a little more mathematically complex. And then the big question is how they're going to pay you back. And that's when you look to income, the individual's income, and how reliable that income is. And what are their other debts? And in case of an individual, what are their living expenses? And of course, in case of a hog operation, how much profits can they realistically make based on the knowledge of the hog market? To be a lender, and I spent a lot of my early career as an agribusiness lender, financing hogs and chickens and turkeys, because BB&T was a farm bank. You do need to develop some understanding of the industry. You need to really, and I knew how to raise hogs, for better or worse, and that enables you to make a judgment of the dependability of the payback. So for an individual, if they've had a job and they've had a job a fairly long period of time, and you can look back at their tax returns for 5 years, you got a pretty good idea. You're not certain because things can happen, what their income is. For a hog business, you can look at the past sum, but you got to understand that the hog business, for example, is very cyclical. There are times you make a lot of money, times you lose money, and can this producer has he got enough wherewithal and enough, I don't know, guts to get through the down cycle of the business? And so that's a kind of judgment expertise you develop over time.
So you had a hog farm experience pretty early in your career, didn't you?
Oh, I did. I wondered why you mentioned hog farms. Yeah.
Well, I've also spent a more time than I should as an urbanite on hog farms myself. So,
Okay.
but
Okay.
but yeah, tell me, recount that story because it's really something.
Okay. We were agribusiness lenders. I made a lot of big livestock loans of different kinds. We had a very large hog producer who I had basically brought into the bank and helped finance. And he'd been a customer for several years. And he'd been in the hog market had been in a very positive cycle where they were making a lot of money. And then the cycle went bad, and people in the hog business started losing money. Well, this customer comes in the bank one afternoon about 4 o'clock and puts a big wad of keys on my desk and says, "Son, they eat at 5." And he walks out the door. so so I get in my car and drive down to this hog facility, which is, I don't know, 75 miles away from where I was stationed. And I go look at the hogs, and we've got 10,000 hogs. And I
Oh,
drive around like I know it.
that's a big
That's a
hog
lot.
farm.
That's a big hog farm. Like I know what I'm doing, and I don't. And so but I did dawn on me that the owner, the guy that had come in to see me, didn't actually personally feed the hogs. So I went down to town and started asking people if anybody knew who fed the hogs. And finally, somebody at the filling station sends me down to see Joe Blow, who was the physical feeder of the hogs. I knock on Joe's door and I said, "Joe, we need for you to feed the hogs." He says, "I won't do it." And I said, "Why?" He said, "They haven't paid me." And I asked him how much he was owed, and I wrote him a personal check, including a week in advance, and he went down and fed the hogs. And then we owned those hogs for, I guess, close to a year. We finally sold them, lost a lot of money. The guy that bought the hog operation made a lot of money because he bought it about a week before the prices went up for hogs. But the moral of the story I tell, and this is a lot fundamental to lending, is during the good times, this individual that owned this hog operation did a number of things that I knew were very questionable from a business perspective and even from an ethical perspective. But I ignored him because he was making money in the hog business. It was a good loan. We were making on the loan. And yet somewhere in the back of my subconscious, I knew we should just run him out of the bank because at that time other people would take him. But I chose not to, and that's why we ended up with that hog loan and the loss that came out of it. And it was a great reminder that you fundamentally lend money to people and that you can't ignore what people do in the good times, because in the bad times, they're going to do worse things. And that was a great lesson, kind of an expensive lesson for me in the bank to learn. And I never forgot that lesson.
What, there's this phrase that I think is almost, I think there's maybe some deeper things behind it. Never, don't throw good money after bad. What does that mean to you as a banker?
Well, it means that if a project is really headed in the wrong direction and there's not some rational reason to believe that it's going to get better, don't keep investing in it, because it's just going to get worse. Now, often that's a judgment call because it's not clear that it can't get better, but there is a tendency when you're already in the hole, when the customer owes you more than the value of their assets, their collateral, to keep investing, because you just kind of are overly optimistic. You're hopeful when you shouldn't be hopeful. It's a reminder to be objective in the lending business, which is sometimes difficult.
So what happened? What happened next? So you get into really doing the lending. Being what was your like job position when you were getting in? Were you a loan officer? What was the actual position?
It was technically a loan administrator, but I worked with a lot of really small offices that didn't have very sophisticated officers in those offices. So even though the loan might be assigned to the Plymouth branch, I would actually end up working with all the larger borrowers. So I was dealing with many of the larger borrowers in the smaller offices, smaller towns.
Now, one thing that as I started to get interested in economics and the because in the aftermath of the financial crisis, that I learned was that banking went through a big change in the 90s, and I think most of us remember, if we're old enough, remember our checking account banks changing hands and changing names in somewhat rapid succession. I had a checking account when I got out of school that was with Sovereign Bank, and then it became Fleet, and then it became Bank of America. And I later learned that what had happened, which seemed shocking to me at the time, was that up until I think it was the 90s, banks couldn't have branches across state lines. Is that right? And why was that?
Well, in a way, it was even worse than that, although it was mostly in the 80s when this stuff started changing. Banks could not have, there could not be interstate banking. And within many states, banks could only have branches in one county. Or in a few states, like Illinois, they could only have one physical building. That was it. The argument from a public policy perspective, well, these local institutions will be more locally oriented. The practical argument was bankers had set up these rules to protect themselves from competition. When I joined BB&T, there was an informal agreement between BB&T and a bank called Planners that we were in Wilson, which was a little tiny eastern North Carolina town, and they were in Rocky Mount, which is another small eastern North Carolina town, but that are about 25 miles apart. But each of the banks agreed not to go to the other bank's market. That was, and in many states, the bankers had gone to the legislatures and got the legislatures to agree not to let you get out of the county. So the industry was very fragmented, and what actually, I think, motivated bankers to get interested in changing the law was that people like Merrill Lynch started offering cash management and other accounts, and they were offering them nationally. And with those products, they could be very, very competitive with local banks who were not efficient. So gradually, the intrastate banking laws and then the interstate banking laws were changed so that ultimately banks could branch nationally. At first, there were regional compacts so that banks in the Southeast could branch. And that meant a huge consolidation in the industry where the better run banks were able to acquire the less efficient banks and improve the efficiency of the industry. And what it allowed the banking business to do is offer dramatically more products than the local bank could afford before the consolidation took place.
So give me a sense of what that means, products, because again, I'm wearing my beginner's mind hat, but what's the bank? What kind of bank product are you talking about besides giving me money?
Well, of course, you have lots of different deposit products. You can have a checking account. You can have a money market checking account. You can have a certificate of deposit. You can have some kind of wealth management account. On the loans, you can have a large variety of loans, credit cards, ATMs. Of course, now a huge percentage of banking is done online, which the investment in that technology is phenomenal. Because banks are actually very complex from an information perspective. You think about, you're looking at millions of transactions happening in the banking business, billions on a national basis every day. And so you had to make a huge investment in the technology. Also, if you had a lot of banks and branches in one market, the individual branches didn't have a high level of deposits or a high level of loans, so they couldn't be profitable. So by consolidating branches together, you were able to afford the employees that you have in the branch because you could keep the lenders busier, you could keep the tellers busier, you could keep the customer services people busier. So it was a real movement towards productivity and simultaneously a movement towards offering many more products in banks. When I went into business, basically you could get a checking account, which no interest was paid on, and you could have a savings account. And the interest rate on the savings account was capped by law. And now, of course, banks offer a multitude of different products with different niches and different kinds of credit cards with different kinds of benefits. And all that became possible as the economies of scale were met as the industry consolidated and made huge investments in technology.
In reading about the Great Depression, I think it was almost 9,000 or maybe over 9,000 banks that failed in the United States. And it's funny because you hear talk of, I think banking's often talked about in terms of having consolidated too much. And maybe that's true now for different reasons. But during the time of the Depression, it seems like this network of banks that are all, or not even a network, this massive number of local banks seemed to be a real problem for the financial system. I mean, what was the, talk to me about some of the things why that branch banking was so problematic, because I know that in Canada you had national branch banking and they didn't have a single bank failure during the entire Great Depression.
Yeah, that's a great point, John. And two things. At the meta level, the primary cause of the Great Depression, and they'll actually admit it now, was the Federal Reserve. It's kind of esoteric, but the world was on a semi-gold standard. There'd been a great gold standard before World War I, but all the economies that were involved in World War I leveraged themselves like crazy to finance the World War. And afterwards, they went on a kind of a semi-gold standard. But what happened, there was a run on gold in Europe, and a huge amount of gold was transferred to the United States, to the Federal Reserve. The Federal Reserve, physically sent to the Federal Reserve. The Federal Reserve was supposed to maintain a certain ratio, like let's just say $100 for every ounce of gold. Well, they got a whole bunch more gold, but they didn't increase the money supply because they were, quote, being conservative, which was absolutely stupid, because the effect was that globally the money supply contracted radically. And that had a huge effect because people couldn't adjust. Wages didn't fall fast enough. Prices were collapsing, and businesses couldn't adjust their debts. So they had debts based on a certain supply of money, a certain amount of money, and now money was actually twice as valuable as it was before, and they still had to pay the debt in twice as valuable commodity. But what made it so bad in the U.S. Was that the U.S. had little banks in every little town, and therefore they couldn't diversify their risk versus what the Canadian banks were able to do. They spread across a lot of different markets. So I'm a little bank in Podunk, and the farmers in my community start going broke, and I go broke. So the inability of banks to diversify their risk caused, in the context of what the Federal was making a meta mistake, thousands of banks to fail. A lot of them were making home loans, and the home owners couldn't pay because effectively their monthly payment on their mortgage had doubled because the Federal Reserve had shrunk the money supply.
So if I'm going to try to stay with our hog farmer example and make sure I'm understanding that sequence. So I'm a hog farmer in North Carolina. John Allison's great grandfather gave me a loan in 2027 or 28, and the price of hogs is $50 a head or something. And now you have this contraction in the money supply. So prices for everything are falling. So now people that are coming to buy my hogs don't have as much money because everyone in total has less money and prices are going down. But then, also the price of hog feed's going down. So in theory, I could be better off and everything could go down. But my debt with you, my monthly payment to BB&T doesn't change because that contract, like our mortgage, is written in dollar terms. I have to pay you back $100 a month, and the price of hogs has collapsed, but I still owe you $100 a month, even though feed's gone down and the price to whatever, all the other inputs, I can pay my workers less because their cost of living's gone down, but my debt hasn't changed.
That's exactly right. And the debt usually was financing, in many cases, physical facilities like the hog facility. Now, maybe in theory, you could rebuild the hog facility for half price, but you already built one, right?
Right.
and the amount of money you borrowed was related to the original cost of that facility, or the bulldozer you'd bought, or the trucks you'd bought. So, most of the financing is going to physical facilities where you paid the higher price, and the amount you owed was related to that higher price. So you go broke.
So so Milton Friedman wrote all about this, about the way the Fed allowed and it sounds like in these some cases created actively this deflation that caused all this trouble. And I know that there was a lot of sort of confused approaches to trying to solve it. FDR ordered people to kill all their hogs. Well,
Right.
Okay, well, hog prices are too low. Let's kill all the hogs. And then that way the price will go back up. But that's sort of
yeah,
right.
But your wages wouldn't go back up, so you couldn't afford to eat.
So, why doesn't the bank renegotiate that contract? Because look, okay, we understand prices have all gone down, so yeah, all right, we'll renegotiate the deal. What made it hard for banks to adapt the way other businesses were adapting in terms of prices? This is something I've never asked anybody, but as I'm thinking about it at this basic level, I mean, a bank is a business. Couldn't the banks renegotiate? What made that hard?
because the bank owed money to other people, and the other people weren't willing to get half as much money. So the bank had taken this $100 in deposits, and they'd lent $90 out to Joe Blow Hog Farmer. Well, if they said, okay, Hog Farmer, you only owe us $45, how could they pay the money they owed to the depositor back?
Right.
And the depositor, didn't want to get half his money back. Now, a lot of them did get half their money back because the banks fail, but that wasn't, the bank really didn't have control of the deposit side because they mostly were lending other people's money because that's how the industry works.
Now, I've heard this argument. There's from people like Murray Rothbard and others that this idea that the bank takes your $100 and lends out the 90, but tells you can still withdraw that $100 at any time if it's like a demand deposit, like your savings account. Like I go to the bank, I put $100 in my savings account, it earns a little bit of interest. The way it earns that interest is because you're lending it out to these hog farmers. But I could take that money out the next day, even if it's not the same money. It's all the money's in there together, and so at any given time. Well, explain how that works. How is it possible that I can give you my $100, you can lend it to this hog farmer, but then I can come in the next day and you have $100 to give me back if I want to withdraw my money? How does that work?
Well, two ways. First, banks keep reserves. They don't lend all of your $100. They put some of it in cash. They put some of it in government bonds that you can sell, immediately. And then secondly, everybody doesn't come in the same day to get their money because they don't need it. So it is a law of large numbers in the sense that, if everybody wanted their money that day, banks normally wouldn't have the cash to give it out. But that only happens, frankly, when the government messes up. Because why would everybody, all of a sudden want their money? It doesn't, they don't need it. And what are they going to do with it? So it's when the government does things like the Federal Reserve did that led to the Great Depression, when you get what's called runs on banks. But banks, if an individual bank was under pressure and it was still solvent, but for some reason people wanted the money out, they can easily borrow money from other banks. So the only way the whole system gets in trouble is if a lot of people across the whole country want their money back at the same time. And that's only happens when you have a panic. And frankly, we've never had panics except when government policy has been the fundamental source of the panic.
Yeah, this comparison between the U.S. and Canada during the Great Depression is always such a great one for me because of that. Because you hear this story that capitalism and that banking is fundamentally just unstable, and that was what caused the Great Depression. There was just everybody got greedy all of a sudden, like gravity increased and planes started falling out of the air.
Right.
Everybody's greedier. And there's the Roaring '20s was super greed, and that's what somehow that leads to everything falling apart. I mean, we heard the same story in 2008 and 9. Well, all the banks suddenly got greedier, and that was the source of the problem. Why do you think that? I mean, when you hear it explained that way, it doesn't make any sense. Like, why would greed change at the level of like the whole society or a whole industry? It's like, if you want to be mean, you could be like, well, all bankers are always greedy. But why are they more greedy today in 2006 than they were in 2002? Like, how do you think about that critique? It's pretty simplistic.
Well, it's very, very absurd. It's a completely irrational argument. But John, I've had this discussion. I've been on TV. I've written books, as you know, about this issue, and I've become convinced it's really an interesting ethical confusion. The two primary causes of the recent Great Recession, the 2008-9 recession, were errors made by the Federal Reserve before the recession, when they overexpanded the money supply, created negative real interest rates, and encouraged people to overinvest and overspend, combined with government housing policy under Freddie Mac and Fannie Mae that encouraged people to buy houses and created a bubble in the housing market, which is the worst kind of bubble you have because it impacts so many individuals. So it was really government policy that caused the financial crisis. But people, I think, want to believe it's greed on Wall Street because, hey, the government shouldn't do something this bad. And I think even deeper, and this is why you see this with conservatives, I believe, I might be wrong, is that people don't want to believe an altruistic motive, which is what affordable housing, now subprime lending, was. It was very altruistic, and yet it is the single biggest cause. The government housing, the housing bubble was called by altruism, that, hey, everybody's supposed to be able to own a house. And people don't want to believe that something they hear at church and hear everywhere is good, altruism, could actually cause a significant problem. They want to believe that greed, that everybody knows is bad, which is not true, by the way, but everybody knows is bad, that causes a problem. So even faced with the facts, and I see this even at academics, that it was really an altruistic government policy, affordable housing, that led to subprime lending, that caused the single biggest cause of the financial crisis. People don't want to believe that. They'd rather believe it was greed, because greed's bad.
Well, I'm gonna come back to this greed versus altruism because it cuts to such a deep part of the way your philosophical perspective. But before I do, sure. You are special in that you've seen this evolution of American banking over the course of several decades, and you lived through the financial crisis running one of the largest banks in the country. And tell me about some of the things that happened that really stuck out for you during that peak moment. So I know, just to kick it off, I know that despite the claim that all bankers are greedy and cause the problem, at least BB&T didn't need a bailout. So tell me about how things started to unfold from inside of your experience, rather than the macro picture of Lehman Brothers, and like how did you experience the financial crisis of 2008? Like, when did it first become clear to you that there was something going on, and what happened next? What steps did you take, and how did they play out?
Well, those are great questions, John. Just to emphasize your point, my company went through the financial crisis without a single quarterly loss, and we're one of the very few large banks that's true for. And I think there's a number of factors. A lot of them are actually philosophical and to some degree intellectual. As you know, I'm a strong believer in free markets. I'm an objectivist, libertarian. Have studied Austrian economics very intently. My whole management team studied Austrian economics intently, and we knew that we have business cycles. And the other thing would be experiential, in that I was running BB&T's lending business in the early 1980s when we had another serious correction. And in the early 1990s, I was CEO of BB&T when we had another serious correction, and I was CEO, of course, when this correction started. So in a certain deep level, we knew we were due for some kind of economic correction. We hadn't had one since the early 1990s. That was a long run. We also intuitively knew the longer the period of good times, the deeper the correction typically is, because people get overly optimistic and make bad investment decisions. And we were observing the housing market, and we were just looking at some basic kind of statistics, which was income to debt service. So that in many markets like California, people's monthly payments were 60 and 70% of their income. And you got to eat too, and you got to have a car. It just wasn't going to work economically. And of course, the way they were doing that, they were refinancing their house every 2 years because house prices were going up. And that can't go on forever because people won't be able to afford to buy houses, the new buyers in the marketplace. So,
and what was driving the housing prices going up so much?
It was basically government policy on affordable housing on Freddie Mac and Fannie Mae. This really goes back to Bill Clinton had set a goal for Freddie and Fannie to have half their loan portfolio in what was called affordable housing, now subprime lending. And there were a number of economists at the time that was announced said this is going to be a disaster because there is a legitimate subprime market, but it's nowhere near that big. And of course, what happened is Freddie and Fannie tried to reach this goal. They had to go deeper and deeper and deeper and make more and more high-risk loans. And the loans got riskier and riskier and riskier. And, of course, they sucked in, and I don't have much empathy from competitors that got sucked in because we didn't, but it was hard not to get sucked in because if you got the biggest players in the marketplace, Freddie and Fannie, and they're making riskier and riskier mortgages, then they pull down the quality in the whole industry. And what was happening was people were buying houses, and they were buying 2 houses, they were buying 3 houses, they were buying 4 houses, and of course that drove up housing prices. And that can go on for a while because people would, the housing prices went up, and then people refinanced their home. The housing prices went up, and they refinanced their home, but it can't go on forever because the prices got so high that new entries, even with these low credit standards, they couldn't afford to buy a house. And a lot of people were, paying, as I mentioned earlier, a very high percentage of their income for housing. We saw that coming. We actually saw it a good bit of time before it happened, and we started getting more conservative. It's difficult. People don't really realize that, but you have to stay in business in the short term to be in business in the long term. And in the short term, it was difficult to go say we had a lot of residential builders, people that built houses, and tell them not to build more houses because house prices were going up, and they're looking at you. And if you tell them too far in advance, they just leave. They go borrow somewhere else. So you have to really feel confident that this correction is going to happen, even if you aren't sure about the turning point. And the other thing we did, and this is a little esoteric, we expanded our government low risk because the government has all the money, our government bond portfolio. Because what happens in corrections is interest rates fall and bonds become more valuable. So we were able to offset some of the losses we would have had in the housing market where we were financing people's homes because we made big gains in the government bonds when interest rates started falling. So we tried to reduce our overall risk by increasing the size of our bond portfolio with low risk short-term mortgages that benefited in a bad economy.
So talk to me a little bit about that. That pressure at the individual level of the banker or the loan officer or the manager inside of a bank when you have this situation, because I think this also cuts to this question of the greed question. So to tell a quick story, so at the time I was living in New York or I was living in New Jersey and working in New York, and I had several friends that were in investment banking. And they were saying things like, look, I have major clients. I have Teachers Union of New Jersey Pension Fund telling me you better give me 8% return on investment.
Right.
Or I'm going to take my money to this guy, Bernie Madoff, that I know is doing great. And so there's this clearly this customer pressure, like you were saying. You've got these builders who are saying, look at the housing prices. Why won't you finance this new model home or this new development? Because it's obviously going to make a killing. I got to imagine there were folks who worried that they would lose their job if they kept saying no to these opportunities.
No question about it, John. I mean, it was a real balancing act. It was a lot of pressure on our lenders. We had loan production goals for the lenders. They couldn't make enough. They couldn't make as many loans as they would would otherwise have made. We in the home mortgage business, we were a very big home mortgage lender. We were mostly originating loans for the secondary market. Some we put in our own loan portfolio, but we wouldn't do negative amortization mortgages where the interest expense is higher than the monthly payment. We thought those were crazy, but everybody else was doing them. So if we have a mortgage producer out there and a customer comes in, they have to convince that customer that this loan that sounds good for the customer, because hey, my payment's only going to be $500, even though my interest is $1,000 a month, and the house price is going up, and they have to convince them that they would get in trouble. Fortunately, a lot of our lenders were able to do that, and it really was a huge benefit for the borrower. But I tell you, this goes back to philosophy, John, and we started out in this, and we got talking more about the business itself. One of the fundamental philosophical tenets that we had in our business, and it comes from a general philosophical principle, is never, ever do anything for your customer that you believe will be bad for your customer, even if you can make a profit in the short run, and even if the customer argues that's what you should do. Because if you don't treat people right and give them the right kind of advance, it'll come back to haunt you in the long run. So we wouldn't do these negative amortization mortgages, even though at the time people were making a lot of money doing those kind of mortgages, and a lot of customers thought that was a good thing. Fortunately for our customer base, we taught a lot of people out of doing it. The ones that went over to Countrywide and did those high-risk mortgages went broke. I mean, and a lot of these were not low-income people. These were largely recent college graduates that wanted to buy a bigger house than they should buy with their income at that level. And a lot of them, got into serious financial trouble. So, but it was the ethics more than the economics, if you understand what I'm saying. We felt like, well, there's an economic basis in it, but we knew it was the wrong thing to do for people. But it was tough. It was tough because you were not making as much money. I had institutional investors that were beating on my door. The bank, fortunately, was continuing to do well, but we weren't doing as well on the surface as somebody like Wachovia that was doing a lot of high-risk lending. And investors would say, wow, why don't you do what Wachovia is doing? I said, you can do that. And we said, because Wachovia will get in trouble someday. Of course, they looked at us like we were crazy, and Wachovia eventually went broke.
So didn't you have shareholders that could say, you know what, this John Allison guy is too conservative. He's got this Ayn Rand idea of like we shouldn't do these things because it's the government screwing things up. We got to get somebody in here who's willing to like grab this golden ring while it's within our reach. Like, how did you avoid getting kicked out?
Well, I think a couple things, John. I had, and not me, but my team had built the bank. We'd built it from a little tiny Eastern North Carolina farm bank till when I retired, it was the 10th largest financial institution in the U.S. We had performed very well over a long period of time, and we'd been very explicit about our values and our culture. We had a very strong value statement with 10 core values. We plastered them across our annual report. We told everybody that bought our stock, this is how we run our business. If you don't like this, don't buy our stock. And we had a fairly large number of individual shareholders who I knew personally, and I would tell them this is why we're doing what we're doing. And interestingly enough, individual shareholders are much more sophisticated, in my view, than institutional shareholders. Because institutional shareholders, their performance is what happened to you that day, right? That's because their mutual funds get repriced daily. A lot of the people that had our stock, we had institutional shareholders. I don't mean that, but a lot of them, had the stock for a long period of time, and they got that. We were running. They thought we were running our business right for the long term. But, I did have institutional shareholders beating on my door and complaining. Our stock price did okay because we became a contra investment. I know people were buying Wachovia and buying BB&T because at some level the institutional investors knew that times might not keep being so good. But it was a struggle, and I know it was a struggle for our individual lenders. our individual producers. We we had a very strong ethics, and this is it's an integrated worldview, I guess. If somebody's a mediocre performer, we'll do everything we can to help them improve their performance. We'll retrain them, and we have fairly good success. And sometimes people just, that they should be doing something else. But if you violate our ethics, you're fired that day. No questions about it. I don't care how long you've been at BB&T. We fired our single biggest mortgage producer over an ethics issue, and he went over to Countrywide. And I'm sure he made a lot of bad loans for Countrywide because he was not truly ethically committed to do the right thing. And that was part of, if you treat your employees with real clear ethical behavior, they're going to get, that's how they ought to treat the customers too, that they ought to do the right thing for the customer.
So to put a cap on things, and move on and move the conversation to those ethics, you managed to come out of this financial crisis having not failed and having the Treasury Department force you to take a bailout. Isn't that right? How does that, so like just sort of wrap up BB&T's emergence from the financial crisis so that, and so clear the deck for us to talk philosophy.
Okay, let me just give you a little bit of context. It's interesting, this recent correction, the 2008-2009, it's called a crisis, and it was a crisis, versus the early 80s and early 90s, when we actually had a much more serious economic correction, but it didn't turn into a crisis. The reason this turned into a crisis was the way the federal government, the regulators, handled a difficult situation. In other words, we needed an economic correction because we had way too big a bubble in the housing market. But it became a crisis because of the lack of rule of law. They saved Bear Stearns, which was a small niche investment banking firm that BB&T had been doing business with for 50 years. Nobody understood why they saved Bear Stearns, and they let Lehman Brothers fail, which was a lot bigger firm. They forced Wachovia into bankruptcy and saved Citigroup, which was in much worse shape than Wachovia. So there was no rule of law, and that's what created the crisis versus the correction. And the crisis made the whole depth of the economic problems much worse than was necessary to have a correction, and contributed to how long it took us to recover. Anyway, the regulators kept coming up with all kind of different proposals to deal with stuff, and one of which was the so-called TARP program, which most people call the banking bailout program. I was adamantly opposed to TARP, the bailout. I wrote Congress, actually went to Congress and lobbied against TARP. Most people don't remember this, but it actually failed in the House the first time around.
Right. And the world didn't end actually that day somehow.
Nothing happened bad that day.
We were told that we weren't going to have an economy on Monday, and then Tuesday comes around and you can still get money out of an ATM machine.
And BB&T was buried with cash, by the way. It's just so interesting. It was a huge flight to quality. The people, we had, our deposits went out the roof. We had people paying us to take their money. They were just taking money out of bad banks and putting it in good banks. Sounds like that makes a lot of sense to me. And the other thing in this distinction between commercial banks and investment banks, there were a few commercial banks that had been high rollers like Citigroup and Bank of America. But most of the problem was actually in the investment banking business and concentrated in a relatively small number of banks. Most banks were doing fine. We were doing fine. Wells Fargo was doing fine. So this perception that the whole world was collapsing was just simply detached from reality. I was opposed to the banking bailout, because it wasn't necessary. I thought these big banks that had done bad things ought to be allowed to fail, so we wouldn't be talking about too big to fail now and how we break up the banks. I mean, the market would have broken up. Banks fail all the time, by the way, and they don't disappear any more than airlines disappear. We probably all flown around on bankrupt airlines. We didn't even know they were bankrupt. In any event, I was opposed to TARP. I lobbied against it. TARP passes anyway. The day after it passes, our regulator gives me a call and says, John, based on all of our traditional measures, your bank is way overcapitalized. You don't have any problems. However, we've decided that we're going to create new measurements, and we're certain that you won't pass these new measurements unless you take the TARP money. And if you don't take the TARP money, we've got an audit team coming in tomorrow, and we suspect that you will fail this audit. In fact, we're pretty sure you'll fail this audit no matter what you look like. In other words, take the money or we're going to close you down. And, of course, we took it. We didn't need the money. It cost us $100 million because they charged a very high interest rate on the money. And then they wouldn't even let us pay it back. They delayed the payback. I think there were two motivations for the government doing that. Same thing, by the way, happened to Bank of New York and Wells Fargo, a number of the stronger banks. What they were trying to do is Bernanke, who was head of the Federal Reserve at the time, had studied the Great Depression and written about it. That's how he got well known. His articles are terrible, but anyway, that's how he got well known. and he in the Great Depression, he believed that when they tried to bail out individual banks, the market would jump on them and those banks would fail. So he wanted it to look like an industry bailout, and the only way he could do that was to force the healthy banks to participate. So he forced people like Wells Fargo, which, by the way, at the time had a AAA rating, and the U.S. government had a AA rating. They were rated better than the U.S. government. So they were forced to participate. We were forced to participate. And then the second thing, Paulson was the head of the Treasury. He was an investment banker from Goldman Sachs. So if you're an investment banker and you're going to make a bunch of investments that aren't very good investments, but you can force somebody like BB&T or Wells Fargo to take this money and you can charge them crazy high interest rates, which they did, then why wouldn't you want the good guys to take the money so that any losses you have will be offset by the high profits you're going to make on the good guys? Why not? So that's what motivated them to do what they did. It was a disgusting experience, frankly, but it happened.
Well, to summarize it, and from a layman perspective, the tactic sounds essentially indistinguishable from the way the mafia approaches a corner store and offers its services.
It's very simple.
I mean, I'm struggling to see the difference here between the regulators and John Gotti. But then you simultaneously have what effectively is a smokescreen attempt to make sure that no one in America knows who's corrupt and broken.
Right.
Which, on its face, when you hear that, I mean, I understand the sort of logic, I guess, but it's a logic of, well, there's a bunch of banks that got in trouble and are terrible, and we can't let any customers know that. Isn't that fraud? Like, how is that not fraud?
It is fraud, and of course, there's no rule of law in any of this stuff. It's they converted Goldman Sachs into a commercial bank over the weekend. They had all these hundreds of rules that you had to go through to become a commercial bank if you're an investment bank, and they just ignored them all and made Goldman Sachs a commercial bank so they could bail them out. Although Goldman claims they didn't need to be bailed out, and I don't know how to judge that, but they did jump on becoming a commercial bank and getting into TARP. I'll say that. So it was really discouraging. It was just it was really discouraging. One thing that pushed the whole thing over, it really wasn't Lehman. If you actually look at the timing, it was a big savings and loan that had become a bank on the West Coast called Washington Mutual. When Washington Mutual failed, the government regulators, the FDIC and the Federal Reserve, chose to pay the depositors 100 cents on the dollar. At that time, deposit insurance was capped at $100,000. And if you had more than $100,000 in the bank, you were supposed to take a haircut. Maybe you get 50 cents on the dollar instead of 100. But they were worried about if they did that, there'd be a run on the banks. But instead of trying to cover that issue with the FDIC insurance fund, which was created for that purpose, they effectively took it out of the hide of the bondholders. And the bondholders were largely, at that point, hedge funds, because the regular investors had sold their bonds at a discount. And maybe the hedge funds expected to get 50% of the original value of the bond. That's what they bought it for. They got killed. Capital markets for banks basically collapsed. And that's what forced Wachovia to basically fail. And it was the lack of rule of law, because you didn't know what they were going to do.
Throughout this conversation, you've talked about a really strong sense of ethics, and you hinted at it in big picture. But where does this come from? Where does your philosophy start, and how do you come to have such a strong philosophical set of ethical things that could guide you through something like this experience?
It's interesting, John. When I went to the work for the bank, I decided I was going to be really focused on self-development. So I committed myself to studying first banking, then accounting and finance and economics. But when I got fairly knowledgeable in all those fields, I decided that there was something deeper and more important. And that was the philosophical principles, because you can't even judge what's right and wrong unless you have some kind of philosophical basis. So I started reading philosophy. I'd gotten interested in philosophy as I was graduating from college, when I read Atlas Shrugged by Ayn Rand, which was a very powerful book for me, but it's a novel and I couldn't totally integrate what she was saying. So I started studying philosophy as I call it a hobby. And my purpose was not really to run the bank. My purpose was to develop a set of principles that would promote my own happiness. What I found is most modern philosophy, not all of it, most of it is just garbage. It's a shame. It's just unbelievable. These crazy ramblings. I got interested in a school of philosophy that starts in a philosopher layman with Aristotle, Thomas Aquinas, Thomas Jefferson, John Locke, and in the modern philosophers is Ayn Rand, who I view as part of the school. And the school basically are advocates of reality and reason. I mean, that's the fundamental thing, that what is, we don't get to make it up. And reason, our capacity to think, is our means of survival, success, and happiness. And then out of that, reason has certain kinds of demands that how you have to live if you want to flourish as a human being. Not just be successful in a financial sense, but be happy. And that happiness, in the Aristotelian sense of a life well lived, is the end goal in life. Not making money, although making money is good. There's nothing wrong with making money, but it's really a life well lived. So that when you're 80 years old, you can look back and say, man, that was tough, and I'm glad I did it. And the irony is, once I really got clear about that, I did get back into Rand and understood her arguments much better than I had before. And when I started focusing on living my life the right way, regardless of the short-term consequences, people kind of started following me. Not because they necessarily agreed with my philosophy, but they saw that I was a principled person who wasn't willing to compromise my ethics. Now, there are a lot of compromises in the concrete things of life, but I never would compromise my principles. And that when I did that, it generally worked. And over time, I was able to develop relationships with people that ended up creating our executive management team. And while we all came from different perspectives, a number of the participants were religious. We all shared a common set of values that we agreed on, that we put in writing, that we were very explicit with our employees. We were very explicit with anybody that came to work for the bank. If you don't agree with these values, don't come here, because you won't be happy and you won't be successful. And during the financial crisis, I had many of our employees tell me that our success, our relative success in a very difficult time, was not because we had any great strategies or grand different ideas, but because we stuck to our values.
So lay those out for me. What are these values that have proven to be so durable and so helpful for having, being a guide in difficult times?
Okay. I will, John. It'll take me a minute, though, okay? Because we have 10 core values. The first value is reality. What is, which we define the ultimate psychological sin as the act of evasion. Evasion occurs when you're presented with some piece of information that needs to be examined, but you refuse to examine because it threatens you something you want to believe. So we always start with the facts, even when the facts aren't convenient to us.
So we can. I'll ask questions as we go since you've got the 10, and I want to hear all 10.
Okay.
But, okay. So reality. So to hear that as just to put a beginner's mind on, like, who doesn't want reality? Like, why is that a special value? What is that in contrast to? Because it's a little bit of a strange thing to assert. Like, why? Aren't we all in reality? Who's not in reality?
Oh gosh, John, I would argue that the vast majority of people aren't in reality. They're detached from reality. They make decisions based on what they wish was so instead of what is so. I think that's one of the biggest reasons banks failed. The CEOs kept doing things when reason and reality together would have told them that it's not going to work. And at some level, they knew that, but they were doing what they wish was so. So, and this is, I have to be careful about what I say here, but I mean, most religions don't really believe in reality. They don't believe in hard science. For example, those that argue that evolution isn't true when there's overwhelming scientific evidence for evolution. So I would disagree with you. I would agree with you that many people would say they don't disagree with reality, but I would argue that the vast majority of people are detached from reality. They don't want to deal with facts, at least in some aspect of their lives.
Well, and I think I think all of us, both with people we know, people we love, and in ourselves, know the moments where we engage in wishful thinking in one way or another. So I can totally see how you've got to guard against that, especially as a company that's responsible for trying to steward other people's money.
Yeah.
But as a general principle. Okay, so principle number 2
is reason. Everything that's alive has a method of staying alive. Lions have claws to hunt. Deer have speed to avoid the hunter. We have the capacity to think. And our capacity to think is literally our only means of survival, success, and happiness. There are no shortcuts. There are no free lunches. When we talked about thinking, we weren't talking about high IQs. We were talking about mental discipline. Mental discipline in the context of having a lifelong commitment to being a learner. And that means you read more, you study more, but particularly you choose to learn from your experiences. Superior experiential learners evade less and they stay in focus more. Focus is paying attention to what's going on in the world. A lot of times people aren't paying attention to what's going on, and therefore they don't learn. And the main reason people go out of focus is they want to evade because they're presented with some piece of information that they don't like. So they go out of focus so they don't have to think about it. So at the end, the goal was to make logical decisions based on the facts. So in a certain sense, even though we have reality and reason is separate things, they're really one. Reason is about evaluating the facts as a human through the human mind to come up with logical decisions based on those facts.
So I know in psychology, emotional reasoning is considered a cognitive distortion. I'm putting air quotes with my hands right now. A cognitive distortion. So when we make decisions on the basis of what we feel to be true, when that feeling is not actually what's true, it's not considered a virtue. It's considered a kind of mental bug, a hiccup in the way we work. Is that sort of part of what you're getting at when you say reason, that to not be an make emotion driven decisions?
That is absolutely part of it, clearly. But the second part, though, John, is deciding you are going to think through things logically. I think a lot of times people, they have emotions, and the emotions are distorting their reason, so they kind of think they're thinking rationally. But it maybe a third party, or even they, if they could get out of their emotional connections, would realize that they aren't thinking rationally. Now, so it's a commitment to. I'll give you a concrete kind of example of what that means. BB&T grew a lot through mergers and acquisitions. In my career, counting insurance agencies and non-bank acquisitions, we bought about 150 companies. We went through a period of time where we were very successful doing acquisitions, and then we got what I called indigestion because we'd grown so fast. We needed to slow down and put together what we'd bought. After we got all that stuff integrated, we went back into the acquisition market, or at least started looking around. And we had these models that were very carefully designed mathematical models based on our experiences of how much revenue and how much losses and how much expenses you could cut and all that kind of stuff. And the acquisitions didn't work out. The bank prices had gone too high so that we couldn't afford to buy these companies. We had a lot of these kind of companies come to us because we were a preferred acquirer, because we treated the people in the companies we bought very well. But we couldn't make the numbers work, so we didn't make these acquisitions. And it was because of this mental discipline that's related to reason. So it's not just saying I think reason's a good thing. It's having a certain kind of mental discipline based on the facts that enables you, when you really want a different outcome. I mean, it would be fun to buy these companies, for lack of a better word, but we didn't do it, even though it was hard not to do it, even though it was tempting. And it's a good thing, because the people that bought them, a lot of them got in trouble. But that's when I talk about reality and reason. It's a very strong kind of mental discipline.
All right. Ethic number 3.
Independent thinking. Independent thinking means thinking for yourself from the facts, reality. We learn a lot from each other. Teamwork is very important. I'll talk about that in a minute. But we think alone. Our minds are not physically connected, and therefore you must think for yourself. And that makes two things both necessary and possible: responsibility and creativity. One of our hallmarks, and I think it's society, it's a critical hallmark, is you are responsible for your own life. You can't view yourself as a victim. If you do, you can't fix anything, because you can't fix other people. Also, you can't control your own life. So we expected people to take responsibility for their own lives. And second was creativity. All human progress is based on creativity. Unless somebody does something better, which will be different, there cannot be any progress. Creativity is only possible if somebody thinks for themselves. That's why entrepreneurship is so important. We were a very entrepreneurial company. We did a lot of things that were different within the context of the rules of being in the banking business. We built the 5th largest insurance distributor in the world from a little tiny agency, farm agency. We were a highly innovative company, and we rewarded creativity in our business, which it is a challenge as companies get bigger. But we were very, very focused systematically on how you do things better, how you be innovative.
So, when you have a bigger enterprise, when you have groups of people, how do you have any advice, or did you learn any tricks to avoid groupthink?
It's a balancing act, John, and I agree with you. What the way we tried to do that, we were anchored in these 10 basic principles, but we argued that everything else was up for grabs. So we actually had our own university, the BB&T University, and we taught courses on creativity, how to think independently, but to think independently in a productive sense. The dilemma you have is people can come up with a lot of crazy ideas or different ideas that aren't practical in an organizational context. So it was a focused kind of creativity, and it encouraged people not to think alike. Our executive management group was selected carefully from my point of view, people that had shared the same values but had a lot of different views of the world. There were some people that were very conservative. There were some like me that were very aggressive. There were some that were like to look at the big picture, and some that like to look at the little picture. So that kind of difference in, I call it methods of thinking, reduces the risk of group thinking. It reduces the risk of group thinking.
So a kind of team of rivals approach, in a sense.
Yeah, but rivals with a lot of respect. A lot of, if Joe says this, I need to take it seriously. I may disagree with Joe, but I have a certain kind of respect for Joe that I'm going to listen to his idea, but I'm not going to necessarily agree with it. And I'm not going to agree with it because it's Joe. Even me as CEO, and I was CEO for a long time, for 20 years, I was on issues that were controversial. We put it up to a vote, and I lost a fair number of votes. And if I lost, we did what the majority of that group had decided to do. But it was a group. It wasn't a democracy in the sense that it was a group that was very carefully selected for their overall attributes.
All right. So ethic number 4.
Productivity. And that's really simply about getting the job done. It's about both thinking and acting. And I think there's a fundamental psychological difference between high performers and non-performers. Non-performers tend to look for the reasons to fail. I visited hundreds of our branches every year, and inevitably you'd go to a branch that things weren't going well, and you'd ask the branch manager, why aren't things going well? And they very typically would say, well, those competitors across the street, they're charging too low rates on loans, they're paying too high rates on certificates of deposits. And look at this street out here. This, stoplight keeps people from getting in the branch. And if those idiots in the home office would fix the computer, things would all be great. Sometimes there was some truth to those arguments. Sometimes we replaced the branch manager and the results got a lot better. I contrast that with our high performers. We had something we call the Sterling Award Group. It was measure of production. There were probably 15,000 people that would participate in this program. And over the years, we had almost nobody that won it every year. But we had the same 25% of the people that would win it. They'd win it one year and come back 2 years later and win it again. And if you talk to them, they would talk to you about how much they had done and how much more they were going to do next year. They faced the same obstacles, but they had a gut level commitment to get the job done. They failed, but they kept coming back. They had a certain kind of tenacity, whereas non-performers look for the reason to fail. So we were looking at people that were actually productive. We measured performance very carefully on productivity. We also, by the way, measured performance very carefully on performance with our values. But in terms of productivity, we were just searching for people that had that kind of tenacity and weren't going to give up. They were going to do, not that they wouldn't fail sometimes.
This could spawn a 2-hour conversation unto itself, but it's hard to measure productivity in a lot of contexts inside of an organization, right? So
sure.
If you're in a sales role, you've got numbers to back up what you're doing, the volume of the business you're doing, how many customers, if you're on an assembly line and how many widgets are coming through your hands. But there's a lot of roles where there's not as measurable a kind of output. So where is it hardest to apply that kind of, and how have you grappled with this challenge of measurement in these areas where internally that are hard to measure? I mean, we have our little company, we're creatives, and it's as the CEO myself, I struggle to think about, what should I measure? What's the cost of trying to measure these things, and is it worth it? And is there just more like a rule of thumb that would be a better way to look at it? Where was this the hardest?
Well, it's interesting. You're right. In the production type jobs, the sales jobs, even the backroom production type job, the processing jobs, you have more tangible objectives. But even where you have a fairly intangible job, what I found that worked was to ask people to set objectives for themselves, and then you look at those objectives and you see how reasonable they are, and it might be that they're just going to write a certain number of things, or prepare a certain number of reports, or those kind of things, or produce a certain number of films. When I went to CATO to run CATO, nobody had any objectives, and yet when I talked to people, they told me about things that they wanted to do, but they weren't doing. And I asked them why they weren't doing them, and they let other things become priorities. So we challenged all of our people to set objectives for themselves. If you want to write a book, make that your number one objective. Make that, that's what you're going to focus on. And we had a big increase in productivity, about 50%, simply by having people set goals for themselves and largely allowing them to pick what it is that they wanted to do. I mean, there were a few people. If people set kind of weird goals from themselves, usually they got other problems. So we found that asking people to set goals for themselves in those areas where it's a little more difficult to evaluate versus sales goals, or where you have multiple incumbents, increase productivity. Was it perfect? No. Is there art in evaluating performance? There absolutely is. There really is. And that's, it often takes somebody that's done the job and done it well to make that kind of evaluation. But I have found in almost all cases, having people set goals for themselves improves their performance and improves the satisfaction from their work.
So, moving on to the next value.
The next value is honesty. Honesty is the foundational value. Without it, basically none of the other values follow. And if you're not honest, you're not going to be trustworthy. Being dishonest is being detached from reality. We talked a lot, though, about the standard for honesty, because this is where people get confused. Honesty is not about being right, because you can be totally honest and be wrong, because we're not, as human beings, we're not omniscient. But there is a standard, and the standard is we need to say what we mean and know what we mean. Say what we mean means we don't consciously mislead people. That's actually pretty easy to determine and pretty easy to deal with at the meta level. It's trickier at what I call the white lie level. And unfortunately, almost all of us are sometimes guilty of white lies. And one thing we tried to focus on is the cumulative effect of white lies is a black lie. I concretize that for you. Tom tells me about Susie's performance problems. But then he does Susie's performance evaluation, and he doesn't really tell her, because it's hard to tell people bad, negative stuff. And then he gets mad at Susie because she didn't hear what he didn't say. And with students, I asked them, well, have you ever done that? to one of your friends? Have you ever been really mad at your friends and not been willing to tell them the truth why you're unhappy with them? And by the way, you might just be wrong, is why you're afraid to tell them the truth. So we tried to talk about the fact that white lies can lead to black lies. Know what you mean is even more important. I found this is particularly important where you're dealing with things like public policy. Know what you mean means you don't claim knowledge you don't have. And you see this in groups where one person acts like he knows what he's talking about and leads the whole group in the wrong direction. With college students, I always ask them, well, have you ever been that person? Have you ever led the group in the wrong direction? And then you have to keep defending this bad position you took in the first place. And in public policy, of course, it happens all the time. People claim knowledge that they don't really have. And that's a form of lying. That's a dishonesty. In fact, in my view, it's more dishonest than lots of other forms of dishonesty, which are easier to actually visualize. We talked about part of honesty is keeping your agreements. And one of the agreements is being on time. You make agreements with other people that you're going to be on time. So you should, within reason, be on time.
Well, that seems like a no-brainer value, but I think that the that knowing what you know is a really interesting layer to add to this, to thinking about honesty and about integrity, because I think, like you said, it is kind of easy to say, well, I'm not going to lie. But then, right below the surface there is a whole lot of thinking and a lot of judgments and a lot of choices that are not nearly as concrete as, that simple, well, I'll just say the thing that I think's true, or that's the fact. So it's interesting. All right, moving on. Number 6.
Integrity. Integrity is acting consistent with your values. There are a lot of apparent temptations in life. We were in the money business. What you can know with certainty, if you developed your principles logically based on the facts, acting consistent with your principles is the way to be successful and happy. And those temptations aren't really temptations; they're just ways to fail. Integrity is the harmony of mind and body. It means if you believe something, do it. One of the biggest things that we wanted to communicate about integrity is that it is not a duty. It's a means to success and happiness. If you've developed these other principles properly, living these principles will promote your life and happiness in the long term. So never compromise your principles, ever. Yes, there are lots of compromises about the content of life, but never compromise your principles, because those principles lead to your success and happiness. And I find that most people think integrity is good, but a lot of people don't. Most people don't act with integrity for 2 reasons. One reason is that they hold values which are inconsistent with life on this earth, altruism being an example. You can't really be an altruist and live. And the other reason, and the more common reason, is people have a hodgepodge of values that are inconsistent with one another. So they do one thing and they feel guilty because they didn't do something else. So one challenge that I offer to students is, if you don't have to agree with my value system, but you need a value system that's consistent with itself. Otherwise, it's impossible to act with integrity. If you have conflicting values that don't really fit together, or values that don't work in the real world that promote your survival and happiness, then you won't live and can't live consistent with those values. So integrity, a lot of people kind of treat it as a bromine, a cliche, but it's really an integrating value. It's saying have an integrated value system, and in our case, one that works in the real world.
So now seems like a good time as any, since you brought it up, to push in on your criticism here of altruism, which I know you've encountered. I'm sure you've encountered pushback on that.
Right.
So what's wrong with altruism? I mean, how could How could you be so dismissive of this thing that isn't that being in the service of others? Like, isn't that great? Why is that a bad thing? Why should I not want to be? Why shouldn't my vision of integrity be about being in the service of others?
Altruism is not benevolence. Benevolence is a good thing. That's a good thing. Altruism is otherism. It says everybody's important but me. Everybody's important but me. There's a fundamental logical fallacy that follows from that is if none of the individuals aren't important. And if everybody's an altruist, right, nobody's important. No individual's important. All the me's are unimportant. Then the standard of value becomes the collective. What is good, quote, for the group. And that is an invitation to tyranny. Because what it says is that individuals don't really know what's good for them. They don't really know how to live their own lives. But I know how they should live their lives because I'm that wise tyrant, right? So altruism really practiced. Now, a lot of people confuse altruism with benevolence. That's different. Benevolence is good. Being nice to other human beings, and if it's no cost to you, helping other people is a good thing. Or even sometimes if it's cost to you, you get some benefits, and all that's good. But altruism really means that you don't matter. Your life doesn't matter. And by the way, it's just a personal tragedy. I mean, if your life doesn't matter? Wow. How can you actually value other people? If you're of no value, then nobody's of any value, right? I mean, it's the same. If everybody is not of value, then nobody's of value. So I think it's if you really understand what altruism really is, and a lot of people use that term with benevolence, and they're really very different conceptual ideas.
So I think that this is perhaps one of the singular biggest challenges a lot of folks who encounter Ayn Rand at like a surface level, and I'm not a expert on Ayn Rand's philosophy, but I'm familiar with this argument, and I think it's something that's incredibly difficult for folks to get their head around. And when you say benevolence, which is a term that I think is a less common word to hear, what does that mean? And what does it mean in comparison to altruism? Because I think sometimes I wonder, is this a problem of culture, or is part of it just a problem of semantics?
Well, it can be semantics if people get confused about what altruism is. And a lot of people that try to sell altruism try to sell it, to soft sell it. It's not. They don't want to sell what it really is. Benevolence means that if you encounter another human being, you're going to start from the belief, unless you have other evidence, that they're a decent human being and deserve to be treated with respect and dignity, just simply because they're a human being. Now, you can have counter evidence that says that's not true, but you start with that kind of belief about other people. But you don't give up you. You still have a right to you. And that doesn't mean that you don't value other people. You might love your children, love your family, love the people you work with. But altruism basically says that you don't matter. If the proper definition of altruism, and I think that's an incredibly destructive idea.
How pervasive do you feel that understanding of this word altruism, or perhaps more important than the word is the feeling of being of, again, I'm saying being of service, but I think that's probably doesn't capture it quite the same way. That, like Mother Teresa is a model of morality because she devoted her life to others, and of course, Mother Teresa maybe loved every day of her life, and maybe that was what made her the happiest that she could ever be. And so is there? I think there's sometimes this interesting question of, you hear all the time how good it makes people feel to give, to be generous. And If it makes me feel good to be generous and I'm doing it of my own free will, is that an act of altruism or is it an act of selfishness? Or is it, like, how do I think about that?
That's not altruism. Altruism really goes back to Kant and the idea that if you get any pleasure out of doing something, you're not ethical. You may not be bad, but if you enjoy doing it, then that's not an ethical act. It is, to me, that's about as anti-human as you can get.
Hmm.
I would say if you really enjoy doing it, um, then that's in your self-interest, right? Um, I think you ought to think about why you enjoy doing it, but if you really enjoy doing it, then it's in your self-interest. It's not really altruistic. Um, Altruistic, as defined by Kant, that's where the word came from, is a morality based on you helping other people but not getting any satisfaction out of doing it. That's what makes you moral. And I think that's a very bad idea. That's my feeling about it.
So where do you feel that this conception of altruism finds its way into our culture? Is it through religion? Is it through Christianity, like Jesus died on the cross for our sins, and that's a selfless act? I mean, you give up your life. Is that the biggest source of that formulation of altruism? Because it certainly sounds like it. I think.
Yeah, I think Christianity and religion in general is a source, although certainly you get to go to heaven. That's pretty high payback. So you can argue that's not really altruistic because I mean it's just because you get to go to heaven. That's big. I think it does come from Kant. I think it comes from modern philosophy. People are taught to be self-sacrificial, and yes, there's a religious connection, but religion is interesting in that there's a payback. It's big. You get to go to heaven. That's not really what altruism is about. It's about self-sacrifice.
So, when people sort of caricature Rand as being about sort of selfishness and everything you've described about the way you've conducted yourself in business, and especially in a world in which you were running one of the largest banks in the world, doesn't align with the cartoon that I get when I watch the show Billions, and they rip on Ayn Rand.
Right.
Because it's like, well, Bobby Axelrod is literally committing fraudulent acts throughout the show, and Chuck Rhodes is like, spare me your Ayn Rand BS.
Right.
So that's the cartoon character. Why is that? Is that because of the language barrier? Is it because she was a tough cookie that didn't exude a softer side? I mean, why does she get such a bad rap as exuding? I mean, she literally says the virtue of selfishness, and that in and of itself is very provocative.
Right.
But you've run a large organization and imbued these values in such a way that has created a totally different kind of culture, it sounds like.
That's true. And there's two things. I'll talk about proper interpretation of Rand in a second, but the first thing, I think Rand threatens the left-wing establishment because she, at a very deep level, is a defender of capitalism, of free markets, of individual rights, of limited government. And people that disagree with her politics have kind of got to disagree with her philosophy, because the politics necessarily follows from her philosophical principles. And so she is the single biggest threat intellectually to the left wing. And that's why, and of course, she's also a threat, frankly, to religion, because she rejected faith. She said, you should act on reason, not faith. So her rejection of faith as a means of knowledge, and the politics, her very insistent advocation of capitalism, free markets, free enterprise, individual rights, limited government, that's a threat to the left. And so in both cases, she becomes a threat. So they take her ideas and misconstrue them. What Rand is primarily an advocate of is what I call the trader principle. And I was going to get to this when we talk about one of our other principles, but I'll go ahead and cover it now. The trader principle is the idea that really life is about trading value for value. It's about figuring out how to get better together, not taking advantage of other people, nor self-sacrificing. That we really are traders. You know, when we were running BB&T, we had a gut level commitment to help our clients be economically successful and financially secure, and we expected to make a profit doing it. There are only two stable relationship conditions: win-win and lose-lose. Whenever you get greedy and you set up a win-lose, your partner's going to get bitter. You see this in spousal relationships, and you both end up in a lose-lose. Ironically, whenever you get self-sacrificial and you set up a lose-win, you're going to get bitter and you end up in lose-lose relationships. So in any meaningful relationship in your life, you should ask, what's in it for me? That's fair. But you should also ask, what's in it for them? Because if there's nothing in it for them, in the end of the day, there'll be nothing in it for you. So the principle that underlies personal happiness, organizational success, and societal well-being is that fundamentally we're traders. It's about figuring out how to get better together by creating as many win-win relationships as possible. And that's really what Rand was talking about. When she used things like the virtue of selfishness, she was trying to get people's attention, and I personally think that was a communication mistake.
I would agree. But yeah, I mean, there's a role for provocation, to be sure.
Yeah, but the idea, the fundamental thing in her philosophy is creating win-win relationships, figuring out how to get better together. And I have found in my career that the vast majority of times there's a way to get better together. Sometimes you can't. There's just no way to work it out. But that is much more the exception than the rule if you really start looking at things from the other person's side. How is this going to help them? How can they win? And why would I want to do it myself? If there's no reason for me to do it, and maybe some of that benefit might be, going back to your discussion before, it might be very intangible. I just enjoy seeing somebody else be happy, right? There's nothing wrong with that. That's good. But it's about figuring out how to get better together. So it's not about taking advantage of other people. That's not productive, not healthy. And it's not about self-sacrifice. It's about trying to create as many win-win relationships as possible. And that's really what we were doing in our business. And that is really, I think, the pillar of Rand's philosophy, although most people don't get that. They hear her because self-sacrifice is so prevalent in our culture. She spent a lot of energy attacking that, and not enough energy, in my view, of really trying to say what really it's really about creating win-win relationships. It's about getting better together.
I feel like one of the areas that we don't, as classical liberals and believers in individual liberty, we don't mind enough is how true what you just said is in our personal lives in very deep ways. And
absolutely.
When, all of us at some point, if you've ever had a crush on anyone that didn't reciprocate or that took advantage of your feelings to make themselves feel good while not reciprocating, how ultimately poisonous that kind of relationship is.
Right.
Even as a parent, we know when we, if we give to the point where we strip ourselves of our own identity, we end up spoiling our kids and wrecking our lives.
Right.
And we know this. It's like we experience it. We maybe at some moments people might not be prepared to accept it, but people around them know it's there. I don't think we spend enough time, for those of us that sort of see the world in this way, connecting those dots to the personal experiences that really resonate with it, because I think we get caught up in systems, we get caught up in the economic domain in which these ethics matter. But what's so refreshing about talking to you, John, is that you're so expert on that domain, and yet you're very quick to bring it back to that personal domain, and that's a pretty unusual thing, I find.
Well, thank you. I appreciate you saying that, and to the degree that that's true, is because I really developed this stuff initially for me, and then was able to apply it to the organization, and so it's kind of who I am. It's like I can't avoid it, if that makes any sense.
So we've got, I think we have a few of your values left. So take me through the rest.
All right. I don't know how much time we've got. Our next value is justice. We believe those that contribute the most should receive the most. Measuring the performance is part art and part science, but the goal is clear. Because we believe in justice, we consciously reject egalitarianism as it's presented in our society today. We think that as presented today, egalitarianism is largely taken from those that produce and given those to the people that have not produced it, and we think that's a form of injustice. In fact, this whole idea today, I think it's one of the most destructive ideas in our societies, is equal outcome. Human beings have attributes as human beings, but I've never met two equal people. Every person I've met is unique, special, individual, which is great. That's what makes human nature so interesting. But we aren't equal. Thomas Edison and the Boston Strangler are not equal. So we really have to be sure those that contribute the most get the most. Our next value is pride. Now that's, a lot of people say that pride is bad, but pride, Aristotle said, was the greatest of all virtues, because to have it, you had to be just, be honest, have integrity, be a rational, independent thinker. So pride is a psychological reward for having done good and a psychological reminder to do good. Something I challenged our employees on many occasions is to ask yourself this question before you do something that has some kind of ethical implications, which is more often than you think. Would you be willing to tell the people you care about what you're going to do, but far more important, why you're going to do it? If you wouldn't tell your people you care about what you're going to do and why you're going to do it, don't do it, because you'll always know why you did it, and you always want to be able to be proud of yourself. Self-esteem and self-motivation is the next value. This is a biggie. This relates to the concept that the fundamental goal in life is happiness in the Aristotelian sense of a life well lived. When you're 80 years old, you can look back and say, man, that was tough, and I'm glad I did it. That kind of happiness, gut level happiness. That kind of happiness has to be earned, and it has to be earned based on rational, real self-esteem, not the bromide and cliche stuff. And you have to earn self-esteem by how you live your life. Live your life with integrity, raise your self-esteem. Another point about integrity is the fundamental driver, self-esteem. The fundamental driver of self-esteem happens to be work, because you spend a disproportionate amount of time, effort, and energy at work. And when I use work, I'm using it in the broadest context. Raising children, very, very hard work. Whatever you define your work to be, what makes it important is it drives your self-esteem. Something I said to the employees of BB&T many times. It matters a lot to BB&T whether you do your job well, but it matters a lot more to you. You might fool me about how well you do your job, might fool your boss about how well you do your job, but you'll never fool you. If you don't do your work the best you can possibly do it, give them your level of skill, give them your level of knowledge. You can't do the impossible, but if you don't do your work the best you can possibly do it, you'll lower your self-esteem. Good news is the flip's true. Do your work the best you can possibly do it, and you'll raise your self-esteem, which is more important than whether you get a promotion or more money, because it's fundamentally about your character.
I think that that the value of work, and I think underneath it is the sense that you're actually creating something.
Right.
I think that below the surface of what you're saying is work is creation.
Yes.
And I think that as much as reason is so fundamental to humans as a that when we tap into that creative nature, when we do something that we can say is ours, it's why make work. But you know when you're doing make work, you know when you've
Oh
got a
yeah. Oh
bullshit
yeah.
job,
Right.
and it doesn't generate the fulfillment that being creative and productive, even if it's not glamorous. And I've done so many projects now, our film The Pursuit with Arthur Brooks and many others, where people in the most challenging circumstances you can imagine, people who are homeless and struggling with drug abuse, people in prison, when they tap into that creative, productive nature of themselves, it transforms their lives. And it's something that I feel very lucky to have seen happen um, in the eyes of people like that, because I think a flippant way to respond to what you just said is say, well, that's a real convenient thing to tell your employees that they're going to get a lot of life satisfaction out of working hard. But I think it's incredibly deep, and it's about as human as it gets.
I would very much agree with that. And the one we didn't talk about, this one context in which we coached or presented our values was purpose. That as human beings, we're purpose-driven entities, and our purpose basically typically has two components. First, I believe everybody wants to make the world a better place to live. You don't have to go to Bangladesh and feed hungry children to do that. Business does that. It produces goods and services, lots of ways to make the world a better place to live. And you need to make the world a better place to live doing something you want to do for you, because you have a fundamental right to your life. But when you talk about work, it is in the context of a purpose. And I think that's what you're talking about: creativity, productivity, but it's about, it's having a purpose in your life, and your work is a way that you can often express that purpose.
Well, um, do you want to close on a little bit about what it means to be a leader? Because I think that I know you've written a book about leadership, and what you've done with BB&T is unquestionably a model of leadership, and the values that you've spent this time together with me laying out um, play a role in what it means, I think, to be a leader. But how do you conceive of what it means to be a leader, and what the role leadership plays in an organization and in society?
And John, in a way, that's a pretty complex question, but I share a couple of thoughts. I think that leadership matters. If you look at organizational failure, the number one reason is poor leadership, and it's usually poor self-leadership. It's the lack of some kind of self-discipline. I think the most important thing that leaders do is inspire a sense of purpose in their team. A purpose making the world a better place to live, and doing it in a way that the individual team members can enjoy it. Not that every day is easy or anything like that, but in a broader context, in that Aristotelian sense of the pursuit of happiness, their purpose fits with that individual pursuit of happiness. And the second thing that leaders do, the most important thing, is have a value system that they live personally, that they're uncompromising about, and that they attract people that fundamentally believe and share those values. I do think that you can't just have any values. So I think the values have to be consistent with man's nature and Mother Nature. Now, the purpose of values to me is to improve the probability of individuals and organizations and society being successful and ultimately being happy. So the values have to, even if they're maybe tough, justice can sometimes be a tough value because you have to deal with non-performance, but that are consistent with man's nature and Mother Nature, the laws of nature. So if you can inspire a sense of purpose in your team and help them see how they're making a difference, and at the same time have a value system that provides the right kind of human behavior that enables people to flourish in that big picture, long-term sense. We talked a lot about our employees being happy in that Aristotelian sense of the word. I'll give you one concrete on that. I would go around, particularly early in my career when I had more time and wasn't so buried with stuff, I would go around and go pick up some of the tellers in a branch and take them out and show them some of the businesses that we were financing and some of our customers, the new boats they had bought and the new houses they had bought, to concretize what they were doing. And I tried the best I could, and I think successfully explain to them how what they were doing at the branch that seemed so detached actually made this business possible that's now hiring 500 people in their community. That without them creating good relationship with their customers, so people wanted to bring in their friends and put deposits in our banks, we wouldn't have the money to lend to Joe Blow to start this business. And they were integral part of that process. They weren't just cashing checks. It was more to it than that. And I find when people get that, they become far more productive and happier in their work.
Well, John, I think we've covered so much that I think is so valuable for people. I really appreciate you taking this time to share not just your business story, but your personal story and your sense of values. And I've learned a lot from this conversation, and I'm really glad that we're going to be able to share it with folks. So thank you so much for coming on board and taking this time together.
Well, thank you, John. I enjoyed talking to you.
Thanks for listening to the Emergent Order podcast. If you haven't already, be sure to subscribe on iTunes, Spotify, or your favorite podcasting app. If you're interested in being a guest, shoot us an email at podcast@emergentorder.com. Our producer is Jesse Bennett. Thanks again, and speak to you next time.